G'day and welcome to this week's video. My name's Robert Gowdy and this week we're going to have a chat about home loans and also comparing home loan repayments to superannuation salary sacrifice. So we're essentially talking about a after-tax payment, which is our interest on our home loans, because at our principal residence the interest is not tax deductible, and on any loan the principal repayment is not tax deductible. So we're essentially trying to compare an after-tax payment to interest and pay down our home loans, and compare that to money going into superannuation as a salary sacrifice in preference to putting more money into the home loan. So a lot of people that I deal with are always trying to top up and get rid of the debt, which is just something that everyone is keen to do to get the bank off their back. But in this scenario, and I'll paint that picture when we go to the screen in a moment, that it's generally, from a tax point of view, not the best way to go. Because any money that you put into superannuation is taxed at 15%, where to pay off your home loan at the average marginal tax rate between $37,000 and up to $90,000 is going to be taxed at 34.5 cents on the dollar. So it's 19.5% saving day one. And as interest rates come down, really what you're saving is becoming a lot less and less. So it makes the tax planning strategy really attractive, but it's not one that I'm really having much luck with clients, because it's just embedded into people to get rid of the debt, and I fully understand that. And what I'm suggesting to clients is that you can implement a strategy where we go back to your minimum repayments on your home loan and max out your superannuation contributions as much as you can. So if I'll go to the screen now, and I apologise in advance for the complexity and the heavy amount of numbers that we have on this Excel spreadsheet. This was put together by Tim Farrelly. He's a chap that we pay to provide asset allocation advice, and also he's clearly pretty good at Excel. So I won't go through it too deeply, but I'll try to cover off the most important areas. It gets complex, and it's one of those documents that I've nearly got to relearn every time I go to it and get my head back around it. But this was a scenario that I worked on yesterday, where a client had a current home loan, and this is mid-50s. We are seeing people in their 50s that have much higher levels of debt than what generations prior had. But this scenario, $368,000 worth of debt. The interest rates are down to around 3.5, so getting very low and obviously coming down further. So the interest calculation on that is $13,000, and they're paying about $14.5 per year. So they're paying well over what the bank is happy with. And what this program does, it takes the difference between the two, assuming that you go back to, say, interest only. Now, I'm not recommending that people do that, because that could affect the interest rate that they get. As soon as you go to interest only, that could increase the amount of interest that you pay, because APRA, the banking regulator, are really discouraging the banks from lending on an interest only, as those interest-only loans were taking up such a big part of the total loan book, and they saw that as a significant risk, which makes sense. But what the calculation is doing is taking the 11,000 and 11,200 or thereabouts, grossing that up in a pre-tax, which gets to around 17,200. Then that $17,000, so that's the pre-tax before you're taxed, has taken 15% out, which is the superannuation tax. So it's really that after-tax 11,200. The pre-tax is 17,200, and then we take off the 15% tax, which represents this figure here, which is approximately 14,650. So this is where the saving sits, that you're nearly getting that 20% saving for every dollar you can put into super, when compared to paying tax at your marginal tax rate at 34.5 to then pay your home loan off. So you can see here that on this column here is the superannuation building up with a 7% return over the next X amount of years, so coming up to $400,000. And what the calculations are doing here is the value, the difference. So as this amount grows, and we can see here at what year we're running at, so year 10, there's $170,000 worth of extra benefit by going down this path. So the benefit is huge, and that is a combination of the tax that's been saved that accumulates within the super plan that you're not sending off to the government when you pay higher rates at your marginal tax rate, and also that money that you're saving, the money that's invested, is not going into your home loan. It's earning an interest rate of 7%. So even if we bring that down to 6% in year 10, it's still $137,000. So it's really a significant strategy. Now I've taken this to probably 6 clients, and I reckon I've got one over the line that will implement the strategy, because they can, just clearly could see the tax difference, and then have money working for you within superannuation that's invested rather than a home loan into our homes. And because at the end of the day, our homes are purely that, they're our home. They're not a financial investment. So it's never going to bring in extra income. If it goes up in value, that's great, but that won't help us with cash and income. Now, from here you can clearly see that we've built up a lot of money. Now that's what can be used when you get to say 65. Whether you're retired or not, at 65 you'll have full access to superannuation, and it'll be tax free, that you make a big lump sum to pay off the home loan. So superannuation first. Think about don't be too focused on the home loan. And this is a strategy particularly that is stronger for people that I would say that are over 45 and in their 50s, because the time to access your superannuation as we get older is becoming closer. So it's a strategy that makes more sense for people in their 50s and their 60s to make sure they maximise their superannuation, and then when they get to retirement or at age 65, they take out a tax-free lump sum and smash it off their home loan. So I hope that was valuable. A bit of a long-winded one and lots of figures which make it more confusing, but just don't forget the difference between your superannuation contributions, your concessional contributions for a salary sacrifice are only taxed at 15%, where marginal tax rates go all the way up to 47-49%. Thank you for listening. Please subscribe to the channel if you got some value out of it. That'd be awesome. And for those that have already subscribed, thank you very much for your support. We'll catch you next week.